Great. Thanks for joining us today, everyone. We are excited to talk about partnerships. And I know we've had a little bit of break from our schedule here, so welcome back to those of you who participated before, and we're happy to dig into this little more tax technical concept. And we tried to make this partnership training fairly basic, so we want to cover the basics, but we certainly want to be responsive to any questions you have, and we will answer questions along the way, as Christina said, so please don't hesitate to jump in or to use the Q&A function as we go along. So glad you're all here. You want to go to the next slide? I think here's our general notice, and I guess I just want to point out that we are going to talk about some examples and things that you might see in the real world, but it's important to remember that everything we talk about here is very general, and as the case with all tax items, general guidance is good, but it is all facts and circumstances, so be sure to think about your specific situation before applying this. And then just the final mention that is dated material, and we would expect things to change. So we'll do a little introductions with the rest of the facilitators today. I've had the chance to talk to this group a couple times. I'm really happy to be back. My name is Kim Suka. I'm a partner in the Power and Utilities practice here. I spend most of my time working with both rate regulated and independent power producers, primarily in the generation area, and spend a lot of time in the renewable practice as well. So certainly see a lot of partnership issues in that space. And so brought along some of our team members that are also in this space, and I'll let them introduce themselves here.
Yeah, good afternoon, everyone. My name's Adam Broders. I'm a tax managing director. I'm part of KPMG's Renewable Center of Excellence. I've been with KPMG for 13 years. And primarily, I focus on partnerships in the renewable energy space.
Hey, good afternoon, everyone. I'm Jared Hines. I'm part of the Renewable Center of Excellence as well, focusing mostly on partnerships. And I've been with KPMG for about 5 years.
Great. Good afternoon as well. My name is Tom Herring. I am from our Kansas City office. I'm a manager in our tax practice. Been at the firm for about 8 years, worked on partnerships throughout, but have recently, right within the last year and a half, joined this Renewable Center of Excellence.
Great. Well, thanks, everybody. You'll be hearing from each of these people as we move along today. And again, I just want to reiterate what Christina said and what I said earlier is we do want this to be interactive. So I know that this the WebEx is not necessarily facilitative of that always, but we welcome you to jump off of mute and just jump in or use the Q&A function on the right-hand side of your screen to ask questions. And we'll be stopping to ask those questions along the way. So let's just jump in. So what we're going to get through today, we're going to talk about partnership concepts just in general, formation, contributions, distributions. We're going to talk about basic allocations and capital account maintenance requirements. We're going to hit on a few of the new reporting requirements that you all are thinking about now if you're involved in the compliance process with partnerships. There's been some new developments there we want to be sure to talk about. And then we want to give a little bit of an intro to the flip partnership structures that you would see primarily in the renewable sector. We know that is certainly a hot topic for many, if not all of you. And so we will have a renewable session here coming up, but we wanted to give a little bit of the partnership insight as to that and to set that up today. So that's what we're going to accomplish. So let's start out at the very beginning, right? Just talking about partnerships in general. You want to scroll one more? There you go. So if we think about what the triangle looks like, just when you think about the underlying tax concepts, right? It's a very simple arrangement. You have two or more parties that are partners. They are that. There's an economic exchange to join the partnership. You either contribute cash or assets. Sometimes you contribute sweat equity. We won't get into those partnership structures today, but you really think about you're exchanging something for an interest in a partnership, And then that partnership goes and runs the business. And so, whenever you step back and think about a tax answer on your partnership, we really kind of look to this aggregate concept, right? The tax answer is generally, it shouldn't be much different than if you owned a portion of the business separately. And so it's something to keep in mind when you're thinking through these issues. But in this case, and this will be one that we go over often, right, or that you think about often, kind of an easy example is you have Alexander and Aaron in our example where Alexander contributes an asset and Aaron contributes cash. And then those assets and that cash is used to run the business. And we'll talk more about the capital accounts and the allocations and basis and all those things. But you can see that right now, this partnership we would expect is really a 50-50 partnership. It's what we say in the example here in bullet number 2. And that's because the asset that Alexander contributed, even though his basis was only $50, the fair value of that was $100, the same as the cash that Aaron contributed. So in that case, from a value perspective, both partners contributed $100 of value, and so they own 50% of the partnership. Now that's obviously a very simple example, and we will talk about more complex examples. But if you always think about this aggregate concept and how the partnership then divvies up the allocations or allocates the income, gain, loss, deductions, contributions, distributions going forward, that'll give you a good indicator of how to treat this. So we can go to the next slide. I think actually maybe 2. Yeah, so here I want to talk a little bit about formation of partnerships. So if you think about the general rule under Section 721 is that the contribution of assets or cash to a partnership is not taxable. And that's really true. And if you think about most situations, that's going to be the case, especially those that you see. There are some exceptions of no gain or loss recognized, especially in the investment partnership aspect. We're not going to focus on those today. But instead, I do want to talk a little bit about the formation of a partnership. That's when we see the most contributions coming into a partnership. And so we just talked about how one party contributed assets and another party contributed cash, and you had the 50-50 partnership. We can make an even easier example where both parties just contribute cash and then you start running the business. I think those are fairly straightforward. You can have gain recognition, not necessarily specifically on the contribution, but upon formation of a partnership. If one partner contributes cash or if one partner contributes assets and then another partner contributes cash, but then that cash goes out to the partner. So let's think about this situation maybe a little more specifically. If Adam and I form a partnership and I contribute an asset that has a value of $100 and Adam contributes cash of $100, but then I get $25 of his cash, we have to ask ourselves what really happened. And in the tax world, that is generally results in a disguised sale, because what I really did was sell part of those assets to Adam, and then we contributed it to the partnership. Those formation rules are also covered under Revenue Ruling 99-5 on ways that we form a partnership from a single member LLC. So while there typically is not gain on a pure contribution of assets or cash to a partnership, there can be gain recognized when you really have one partner selling to either the other partner or the partnership itself. So always keep those in mind when you have cash coming in and out, you want to look at that, or when you have cash going from one partner to another to form the partnership, there will likely be some sort of taxable event at that time. Can you go to the next slide, Christina? Yeah, so here I want to talk a little bit about inside basis and outside basis. So can you use the emojis and just tell me if you have a really good understanding already of what inside and outside basis is? See the little emojis at the bottom? Give me a smiley face if you really understand it, or yeah, thumbs up, thanks. Okay, so most everyone has this concept. I think there were a couple of people that were brave enough to say that maybe they don't have this down. So let's go over that a little bit. The inside tax basis is what the partnership, what the basis is in the partnership's hands. And so if you think about a real simple example, if the partners both contribute $200 and then the partnership goes and buys an asset for $200, the basis of that asset is $200 in the hands of the partnership. And that is what's used to calculate depreciation, amortization, deductions for the partnership, right? If you think about even just the reporting of that on a return, excuse me, that would be how you calculate that. The partnership might have received assets, in which case there's a carryover basis concept. So the inside basis of the partnership is the basis for the asset that's been contributed. For tax purposes, we'll talk about capital account purposes later, but for tax purposes would still be that basis that was in the hands of the partner. So in the example I gave before where Adam and I formed this partnership, we would, the basis in the hands of the partnership would be the same $50 of the adjusted basis that I had in the asset that was contributed. Importantly, the inside basis is also used to calculate basis for the investment tax credit if you're looking at renewables. So that's an important thing, and we do a lot of planning around getting the most basis possible for that purpose. The outside basis, however, is what the partner's basis in the partnership interest is. And so that is what my outside basis is, not the value, but the basis that I have in that partnership interest. And so upon formation, right, if you have two partners that contribute cash, the inside and outside basis is the same. And if the basis, or if the partnership goes and operates the business, and those amounts, you don't have any changes to the ownership or outside ownership of or sales or exchanges of partnership interests, we're likely going to have the same inside and outside basis. But there are many transactions that could cause a disparity between the inside and outside basis. And so it's important to track both of those as you move forward. The outside basis is what's used to determine my basis as a partner in the partnership, my basis. So if I were to sell my interest in the partnership, I would look to my outside basis. And importantly, we pointed out here, it's also used, we do include liabilities. So my share of liabilities that are appropriately allocated to me increase my basis in the partnership. And if I were to have a shift of those liability allocations, that would be either an increase or decrease depending on, the change in liabilities there. And then the other real important thing about outside basis when you're just even operating the partnership is if you're making a distribution, you can have a gain for the partner if distributions exceed the outside basis of that partner's interest. Okay. I'm going to pause for just a second and make sure we don't have any questions coming in. I think we're good. Okay. Let's talk a little bit about holding period. So generally, the holding period in a partnership interest is the same, right? So if you contribute assets to the partnership, then, and though that's a capital asset or 1231 property, my holding period in the property carries over to the partnership interest. But if I contribute cash or any other asset that doesn't fit that description, then I have a new holding period. So that's really important when you're looking at especially a capital transaction. So if you were to sell your partnership interest and you hadn't held your partnership for more than a year, you could have some issues there for short-term capital gain purposes. Okay, you can keep going. And then character. So this gets back a little bit to the aggregate concept and how you think about the character of gain and loss and deductions, right? So the partnership, the business, right, is going to recognize income and loss and have those deductions, and then that gets allocated out to the partners. So a partnership, by definition, doesn't pay its own tax, but instead allocates that out to the partners, and the partners pay the tax on the income or loss that is generated by the partnership. Okay, we are ready for our first polling question. So I trust you have all logged in at this point. And you can go to pollev.com, PU 2021, and our first knowledge check should be up. So here, George contributes a piece of land to partnership in exchange for an interest in the partnership. At the date of the contribution, George's basis in the land was $100,000 and the fair market value of the land was $250,000. What is George's basis in his newly acquired partnership interest? Is it the $100,000? So that's the basis that George had before in the land that was contributed. Is it $250,000? So that's the fair market value. Is it $150,000, which is the difference? Or does he have to start all over and not have any basis? Give you just a minute to answer that before we scroll through. Christina, are we getting a lot of responses?
Yep, they're coming in.
Okay.
It looks like they've slowed down if you want to go ahead and go over the answer.
Okay, let's go to the next one. So hopefully we talked about this enough that you got this right. The answer is $100,000. So that is the basis that George had in his hands when he contributed those assets to the partnership. He has carryover basis in there. Okay, we're going to switch topics, and I think, Tom, are you taking it from here?
I am. Thank you.
Great.
All right, so let's jump in and talk about capital account maintenance, the basics. We can go to the next slide.
And if we can get you to speak up just a little bit, you're a little low.
Okay, I'll do my best. Typically, there are three types of capital accounts. GAAP, which usually are not relevant to tax allocation. Then we have tax capital accounts, and these reflect partnership accounting using tax basis of accounting. And then we have our Section 704B capital accounts, and these reflect partnership capital accounts using an economic basis of accounting. Today's session, we're really going to focus on how to calculate and maintain Section 704B capital accounts, and maybe more importantly, why it is important to do so. So as we mentioned, 704B capital reflects the partner's fair market value equity ownership in the partnership capital on the date the partnership is formed or revalued. So the purpose of maintaining these Section 704B capital accounts is to track each partner's economic investment in the partnership assets. So 704B book basis capital accounts generally represent what each partner is entitled to at liquidation. And so it's important to, when you think of 704B, think value, think fair market value, to kind of differentiate between GAAP tax and 704B. I think Kim mentioned this earlier in some of her slides, if both partners contribute cash and the partnership is formed with all cash, 704B capital and tax capital will be the same. In this renewable energy partnership space, this is not what we typically see. We usually see one party contributing property and one party contributing cash. And so the difference between the 704B and tax capital relates to Section 704C items, and that will be discussed a little bit later on in the slides. Another reason why it's important to maintain your Section 704B capital account, well, most partnership agreements require the use of these capital accounts. And if that wasn't enough, even if the partnership does not require them, they will likely be needed in order to confirm that partnership allocations are valid. And kind of another preliminary partnership accounting step you want to take, as you get into these partnerships, is you want to set up and track a tax basis balance sheet, which this is tracking your tax basis capital and tracking your assets and liabilities on a tax basis. And you also want to track your Section 704B book balance sheet, which is reflecting the fair market value of your assets and liabilities. And so as you think about that, you start with your GAAP basis balance sheet, you make your tax adjustments to get to your tax basis, And then from your tax basis, you make your 704B adjustment to get to your 704B balance sheet. And so at the end of the day, when you're making sure that everything is in balance, your Section 704B capital account roll forward should tie into the equity section on your Section 704B balance sheet. And so maybe one of the most important things to note here is that it's important to track these items from the inception of the partnership, because at some point you'll need your capital accounts either to confirm allocations or, say partners are getting into and getting out of the partnership, you'll need your capital accounts at that time. And so if you don't track these from the start and you're trying to build this from scratch 5 years down the road, at that point it can cause some headaches and cost you a lot of time to try to rebuild those from 5 years of information instead of trying to get it right at the start. Christina, we can go to the next slide. All right, allocations and capital accounts. We can go to the next slide as well. And I believe we can click 3 more times just to get everything on the slide. Perfect. All right. So before we jump into IRC Section 704B Safe Harbor, maybe we can just briefly discuss IRC Section 704 at a high level. So Section 704 defines what a partnership agreement is and states that the partnership agreement generally determines a partner's distributive share of income, gain, loss, deduction, or credit. A partnership agreement includes all agreements, and those can be written or oral among the partners. And to ensure that any modifications to your partnership kind of make it into the tax year, the amendments to the agreement need to be made by the due date of the partnership return, not including extensions. So there are some elections and other items for tax purposes that you can make that election at 9/15 versus 3/15. But for this, in order to incorporate these amendments, it has to be done at 3/15, and it does not include the extension. So Section 704B regulations also provide a safe harbor for allocations in a partnership agreement to have substantial economic effect. We will expand on that in a little bit. They define partnership's interest in, or partner's interest in the partnership. And they provide a safe harbor under which allocations of certain items are deemed to be in accordance with the partner's interest in the partnership. So as we move on to some of the information in the slide, I'd like to note that one of the, sorry, we can go back, Christina. Sorry, there's a lot of talking points for this one. So one of the fundamental principles of partnership allocations under 704B is that allocations of tax items must be consistent with the underlying economic arrangement of the partners. So said another way, if there is an economic benefit or an economic burden that corresponds to an allocation, the partner to whom the allocation is made must receive the benefit or bear the burden. So if you're thinking about from a partner perspective, most partners are interested in how the economics will impact their cash flow and their income taxes. So the overall goal of ensuring that the allocations in the partnership agreement have substantial economic effect is to ensure that our allocations, and then sorry, let me back up. The overall goal of ensuring that the allocations in the partnership agreement have substantial economic effect and will be valid is to make sure that the underlying economic arrangement that you agreed to with the other party is going to be respected by the IRS, and you don't get an unexpected answer at the end of the day when you receive your K-1. So to determine, how do we determine if the allocations in the partnership agreement meet the fundamental principle as we discussed above? Allocations can be in accordance with the partner's interest in a partnership. We'll kind of hit that in a bit. Or the IRS has this safe harbor for economic effect to be satisfied. And so there's a two-part test for substantial economic effect, and that's economic effect and substantiality. And so you test economic effect annually, and you test substantiality generally when the allocation becomes part of the operating agreement. So as you see above, or on this slide, we're going to focus on the safe harbor for economic effect. And so there's three ways to have economic effect, and that's meeting the requirements under, 1, the general test, 2, the alternate test, and 3, the economic effect equivalency test. So the three requirements for the general test: partnership allocations will have economic effect if and only if throughout the full term of the partnership agreement provides for determination and maintenance of the partner's capital accounts in accordance with 704B. And then 2, upon liquidation of the partnership, liquidating distributions are required in all cases to be made in accordance with positive 704B capital accounts to the partners. And then 3rd, and this is 3A on the slide, if a partner has a deficit balance in his capital account following the liquidation of his or her interest in the partnership, there's an unlimited obligation to restore the amount of such deficit balance to the partnership by the end of such taxable year. And so those three make up the general test to make sure that your allocations have economic effect. And so just real quick about the alternate test, 1 and 2 on the slide are the same, but under 3B, there is also a provision in the operating agreement that we call it an qualified income offset, or QIO, which we'll discuss in a few slides. And that is in cases where partners don't want to sign up for an unlimited deficit restoration obligation. So with that, we can go to the next slide. All right. As noted previously, the allocations must have substantial economic effect. So what does substantial mean? The economic effect of an allocation is substantial if there's a reasonable possibility that the allocation will affect substantially the dollar amounts to be received by the partners, independent of tax consequences. So said another way, income allocations will result in an increased entitlement to cash. And as we mentioned under the 704B capital account slide, right, that 704B capital account represents, kind of what you're entitled to at liquidation. And then, so on the flip side, allocations of deduction results in a decreased entitlement to cash. And so for substantiality, as we're testing this, we're really looking at the impact to each partner's 704B capital account and then their individual tax burdens during the year. So a partner's capital account will not be different, but their individual tax burdens are reduced as a result of the allocation. It is likely that the allocation will not have substantiality. But this largely prevents a partnership from manipulating timing differences with respect to deductions or manipulating tax rates by allocations of, class of income or, think character of income, such as all capital gain to a partner, who has large unused capital losses, just for one example. And then, as noted here on the slide, there, regardless of the above, the economic effect of an allocation is not substantial if at the time the allocation becomes part of the agreement, any of these tests is violated, and that's the overall test, the overall tax effect test, the shifting allocation test, or the transitory allocation test. And so we have a slide that goes pretty in depth on each of these, but just at a high level, the overall tax effect test is looking at the after-tax liability and one partner is better off and no other partners are worse off. The shifting allocation test relates to shifting the character, but not necessarily the amount of income or loss to the partners within the same tax year to minimize the partner's tax burdens. And then the transitory allocation test, this is a situation where the allocations, you have offsetting allocations across tax years to the same partner. And so they don't impact the economics of their partnership, their interest in the partnership, but reduce his or her tax burden during the year. So when you're looking at that one, the total tax liabilities of partners for the years is less, but the total net allocations over a period of years do not differ. Okay, I think we can go to the next slide. And with that, we'll jump into the poll number 2. So if you want to take a second to pull up your poll everywhere. All right, so for knowledge check 2, the general test for determining if a partnership allocation meets the Section 704B safe harbor for economic effects includes all but one of the following. Which is incorrect? So I'll give you a moment there to read through A through D, and then we can proceed.
And they're coming in. We'll just give it a few seconds.
Perfect. Thank you.
Okay, I think the majority have answered.
All right, we can move on to the answer then. Next slide. Yep. The correct answer was D. The partnership agreement contains a qualified income offset or QIO provision. And as we noted before on one of the previous slides, the QIO provision is a component of the alternate. That's for for economic effect. All right, next slide. All right, requirements for economic effect. So we previously discussed the general test for economic effect. So now we'll discuss further how to have economic effect in the event that there is no unlimited deficit restoration obligation in the partnership agreement. So under the alternate test, allocations can still have economic effect if the partnership maintains Section 704B capital accounts, the partnership liquidates in accordance with positive 704B capital accounts, and 3, the partnership agreement contains a qualified income offset provision, and 4, allocations are not made to a partner that would cause or increase a deficit balance in such partner's capital account in excess of any limited deficit restoration obligation undertaken by the partner. And so partnerships relying on the alternate test for economic effect described earlier generally contain contain the following provisions. Qualified income offset provision, which is required for allocations to have economic effect, a gross income provision, which is not required, a loss limitation provision, which is required, and lastly, they have a curative allocation provision, which is also not required. And so, qualified income offset provision. So essentially, this provision requires the partnership to specially allocate items of income and gain to a partner as soon as possible if a partner's capital account is unexpectedly driven negative beyond any limited deficit restoration obligation. And so the key term here is unexpectedly. And because of the unexpected language in there, we do not see this QIO. We see it in the agreements a lot, but we don't see it come into play as much because with proper planning, there's not necessarily unexpected distributions or something that would drive your capital negative. The gross income allocation which is not required to be in the agreement, states that if a partner would have a negative capital account balance beyond any limited deficit restoration obligation, this provision will allocate gross income items to that partner to attempt to cure the issue in the current year. See here. And so it's important to note, kind of for this gross income allocations for generators of electricity and sellers of electricity, the IRS views sales of electricity and electricity as inventory. And so when you're trying to separate items of gross income, gross revenue from the sales of electricity is netted with your cost of goods sold and your depreciation. So as you're looking at the operating agreement, and you may be contemplating whether or not this gross income allocation is applicable, you may not have as much gross income, once you net that revenue with your cost of goods sold and depreciation. The loss limitation, which is also required to be in the agreement. So when partners do not have an unlimited deficit restoration obligation, this provision is necessary to reallocate those losses away from a partner that would otherwise drive such partner's capital account negative beyond their limited DRO. This provision is effectively required by the regulations in order to prevent impermissible negative capital account. And so this provision we do see fairly often in the renewable energy space. So as we think about capital accounts and items that will drive your capital account down, you think of losses and deduction items, and that, in this renewable space, which are fixed asset intensive, and a lot of 5-year property, due to those depreciation deductions early on in the partnership, we see, partners' capital accounts get depleted fairly quickly and reach their limited DRO or reach zero without the DRO. And in that situation, we have to reallocate those losses to the other partner who still may have positive capital. And then the curative allocations, also not required to be in there, but this provision, that states that, the regulatory allocations may distort the intended economic arrangement of the partners. So this provision's in the operating agreement to cure previous regulatory allocations that may have impacted your economic arrangement. So say you have a 50-50 partnership, and over the life of the partnership, the other partner's capital is at zero, and so you've been getting additional losses that you didn't, let's call it, sign up for. At the end of the day, once the partnership has income, that income will be allocated to you first to the extent of those additional losses that were allocated to you. We can go to the next slide, Christina. Okay, and as mentioned earlier, this slide here gives a good high-level and a little bit more detailed overview of the overall tax effect shifting tax consequences and transitory allocations. We can go to the next slide. All right, so maintenance of your Section 704B capital accounts. So first, it's important to note that you have a single Section 704B capital account per partner. And to maintain those, step one is determine your initial capital account balances, and that includes money contributed to the partnership by the partner, plus the fair market value of property contributed by the partner to the partnership, net of any liabilities, to the extent that the partnership assumed that liability on the property contributed. Step two is you're going to adjust your 704B capital account for subsequent contributions and distributions. And your capital account will increase for the contributions, and it'll decrease for distributions. And then step 3, you're going to adjust for items of income, gain, loss, and deduction. And so when you're calculating your Section 704B income, your starting point is partnership taxable income. And from an economic, and so think of your 704B count from an economic standpoint. So you're going to add the amount of partnership tax exempt income or gain and subtract the amount of partnership non-deductible expenditures. So from an economic standpoint, you paid cash for those. And then you're going to make adjustments for gain loss on sale of assets, where the basis is different, where the 704B basis and tax basis is different. And this is a transaction where the property is actually disposed and gain or loss is recognized for federal income tax purposes. Also noting there, for the renewable space, your 704B capital account is also decreased by half of the ITC credit that you're allocated during the year. And then your partnership can also be adjusted upwards or downwards for any required or elective revaluation of partnership property, which we'll discuss here in a second. Next slide, Christina. Okay, so this slide just covers partnership Section 704B book income and how to calculate it. And just one thing to note here is that your Section 704B depreciation can be calculated in a few different ways depending on kind of which method you are using, and that's traditional method, remedial method, and Adam will cover that here in a second. Next slide, Christina. All right, we are ready for question number 3. Please navigate to your Poll Everywhere window. All right, knowledge check 3. Which of the following items do not increase a partner's Section 704B capital account? Give you a second there to read through A through D and submit your answer. How are we doing on responses, Christina?
We have about 90%. Go ahead to the answer.
Yep. All right, and the correct answer there is the tax basis of property contributed by the partner to the partnership where such property has a Section 704B book value greater than its tax basis, right? And so on that, we were focused on your 704B capital account, so we want to focus on the 704B book basis of the property contributed and not the tax basis. All right, okay, great, we're on the right slide. All right, so as mentioned earlier, your 704B capital account can be adjusted upwards or downwards for 704B capital account revaluation. So revaluations are permitted when there is a change in ownership structure. And I think the most common change in ownership structure that we see occurs when there's contributions made for an interest in the partnership, or there's a complete or partial liquidation of a partner's interest. And so what this revaluation does is it serves to lock in that built-in gain or loss prior to the change in ownership. And so it locks in the economics of the partnership so that that gain or loss is not improperly shifted to a particular partner. Important to note here that revaluations are permitted, but they're often not required. But if they're not done, distortions may result in the economic sharing arrangement between partners. Also important to note here for the 704B capital account revaluation is this is not a taxable transaction, and there's no impact on the tax basis of the property. It is a revaluation of the 704B basis of assets and liabilities. And kind of mechanically how it works is you book up the existing partners prior to admitting new partners. And so maybe just a real quick high-level example, say Adam and I form a partnership 50-50 and we each contribute $1,000. So the partnership has $2,000. The partnership goes and buys some land. Nothing else goes on for years 1, 2, or 3. And so at year 3, that land has appreciated to $3,000. If we're going to admit a new partner at this point in time, the partnership value is no longer $2,000, it's $3,000. And so we have a $1,000 built-in gain or some appreciation. So if we admit a new partner now, we can book up our capital accounts to $3,000. And in that situation, we kind of lock in that $1,000 built-in gain, and allocate that 50-50 prior to the new partner getting in, and then under the properties of 704C, will ultimately be allocated that first $1,000 of gain when that land is sold. So just to kind of recap, kind of steps in considering a 704B revaluation. First, you need a qualifying event, which are listed up on the slide there. 2, you're going to need to determine the fair market value of the partnership. 3, you determine the amount of the 704B revaluation gain or loss. And then 4, you allocate that revaluation gain or loss in accordance with the partnership agreement. Next slide, Christina. Okay, this slide, the top section kind of recaps what we just discussed, but I wanted to note here that, transfers and sales of interest are not a revaluation event, and that the transferee partner generally steps into the shoes of the transfer's capital account. Next slide. All right, again, if the allocations in the partnership agreement do not meet the safe harbor provisions or do not have substantial economic effect, allocations can be made in accordance with partnership's interest in the partnership. This partner's interest in a partnership is really the manner in which the partners have agreed to share the economic benefit or burden to each corresponding item allocated. This is really facts and circumstance based. It kind of takes into all those factors listed below. There is some flexibility in these allocations. And one note, if you're familiar with target allocations, partnership agreements that liquidate based on a distribution waterfall are respected under partners' interest in a partnership as opposed to safe harbor. I think with that, I will kick it over to Adam to go over some 704C allocation.
Yeah, thanks, Tom. So everybody's favorite partnership topic, 704C allocations. Christina, you can go to the next slide. Okay. So whenever a partner contributes appreciated or depreciated property to a partnership, Section 704C is going to need to be considered. And Section 704C is really designed to prevent the shifting between partners of the gain or loss that is embedded on the contributed property. And this is really accomplished by making sure that built-in gain or built-in loss is allocated back to the contributing partner. So one thing to consider with 704C, you kind of need to look at the type of property that was contributed. So if the property that was contributed with a built-in gain or loss was depreciable or amortizable, then 704C allocations are likely going to be kind of run off over the life of the asset. And then if the partnership were to eventually sell that asset, and it had 704C attached to the asset, any remaining 704C would kind of be realized on the disposition of that asset. There might be certain situations where the property contributed that has the built-in gain or built-in loss is an asset such as maybe inventory. And in situations like that, the 704C allocation is going to be realized when the inventory is sold. One item to note in regards to 704C, this may impact the allocation of non-recourse liabilities under Section 752. And there are currently kind of three reasonable allocation methods out there for allocating 704C. You have the traditional method with curative allocations, and the remedial method. Christina, if you can go to the next slide. Perfect. So as discussed on the previous slide, the real purpose of 704C is to ensure that the partner who contributes the built-in gain property is allocated the gain. So just to give you kind of a simple high-level example, if Jared and I form a 50-50 partnership and I contribute an asset with a tax basis of $50 and a fair market value of $100, so a built-in gain of $50, and Jared contributes $100 of cash, 704C is going to ensure that I am allocated $50 more of taxable gain over the life of the asset, so that at the end of the day, both mine and Jared's capital accounts from a tax and 704B perspective are both at a 50-50 split. And these three 704C methods that are depicted on this slide are going to help achieve this kind of reallocation of tax items. So in thinking about 704C, you kind of need to go through a couple different steps. So your first step in regards to 704C allocations is going to be to calculate the tax depreciation for the partnership. Next, you're going to calculate the 704B depreciation for the partnership, which is going to include, the 704C asset, the depreciation on that asset, in addition to the tax asset. Kind of the third step is going to be allocate out your 704B items to your partners in accordance with the partnership agreement. And then kind of the last step is now you need to allocate the tax items to the partners. And what really happens is the non-contributing partner, they will receive tax allocations equal to their 704B allocations. And then the remaining taxable income loss items are going to be allocated to the contributing partner. And differences will definitely exist depending on what 704C method you use. For example, the traditional method and the curative method, 704B depreciation on that 704C asset is going to be recovered over the remaining tax life of the property. Whereas on the remedial 704C method, the 704C asset is going to be recovered over a brand new tax life. One issue you can run into on the traditional method is ceiling rule limitations. So just kind of expanding on my example of, me and Jared have a 50-50 partnership. Let's say that tax depreciation for the year is only $2 and 704B depreciation is $10. And Jared, again, is the non-contributor. I'm the contributor of the built-in gain asset. So Jared and I would first be allocated $5 of 704B depreciation. Jared then, as the non-contributor, he needs to be allocated $5 of tax depreciation so that his tax equals his 704B. But there's not enough to do that because there's only $2 of tax depreciation inside the partnership. So this is really where the ceiling rule limitation comes into play. And as a result, Jared is only going to be allocated, $2 of tax depreciation, and he's going to have a disconnect between his tax and 704B depreciation. So the ceiling rule, it could possibly be cured by the curative method. It's not guaranteed though. So under the curative method, what you can basically do is look to other items of the same character as the ceiling limited item. So in this case, we're talking about the built-in gain is on depreciable assets, so we're looking at tax depreciation. So under the curative, you can actually go see if there's any other tax depreciation that you can allocate to Jared as the non-contributor to get him up to his $5 of 704B depreciation. So what would end up happening is Jared would be allocated the $2 of tax depreciation associated with the built-in gain assets. And then let's say there's $6 more of tax depreciation on other assets. Jared would first be allocated $3 of those to take him up to the $5 704B depreciation. But under the curative method, you still could run into situations where there's not enough depreciation to fix the ceiling rule limitation. For example, in my example, you could only have $1 of additional tax depreciation, and you're still going to be short. So really, the only method that you're able to fully cure the ceiling rule limitation is the remedial method. This is going to solve the ceiling rule limitation every single time. So back to my example, there's only $2 of tax depreciation. That's going to be allocated to Jared. And then the remedial method is going to end up creating a remedial deduction of $3 and a remedial item of income of $3. So overall taxable income isn't changing, but you're basically kind of making up these items of income and deduction that net to zero. And this is really going to ensure that Jared, as the non-contributor, is going to be allocated enough tax depreciation equal to his 704B depreciation. So kind of how that works is Jared would have $2 of tax depreciation. He would be allocated $3 of remedial deductions. And me as the contributor, I would be allocated $3 of remedial income. I think we can go to the next slide. And that was just a pretty high level examples. 704C can be extremely complicated, especially when you have lots of assets that are contributed with built-in gains or built-in loss. But the example I kind of went through was, pretty basic. So I think if everybody can log on to Poll Everywhere, and we'll go to the fourth knowledge check. So which of the following statements about curative allocations is correct? A, curative allocations may solve a ceiling rule problem. B, curative allocations always solve a ceiling rule problem. C, curative allocations generally may be allocations of other tax items with tax characteristics different than tax items causing the ceiling rule problem. Or D, curative allocations can exceed the amount necessary to solve the ceiling rule problem.
We're about 60% there, so they're coming in.
Okay, perfect. So hopefully, if you go to the next slide, hopefully everybody selected A. As I mentioned, curative allocations may solve a ceiling rule problem, but you could still end up in a situation where you still have the ceiling rule limitation, and really the remedial method is going to be the only method that is fully going to cure the ceiling rule limitation. So I think with that, I will turn it over to Jared to go through some of the reporting requirements.
Well, thanks, Adam, for making sure I get my fair share of depreciation there. As discussed, my first topic here is going to be new reporting requirements, or relatively new. And further ado, the very first topic here is going to be tax basis capital account reporting. So the IRS is going to make sure that on item L, the Schedule K1 and M2, that it's done on a tax basis method, specifically using a transactional approach, which is similar to your contributions, distributions in, and then what's reported on your K1 for that income, as well as any tax-exempt income, non-deductibles, really just getting as close as they can to your tax basis. There are a few other circumstances. If you can't get there, they'll let you use a method, and I'll highlight that here in just a little bit. But first, let's talk into scenario 1, is where we reported tax basis method in the past. Then your beginning capital account should equal your ending year for 2019. If it's not appropriate or you believe an adjustment should be necessary, we're going to flush this through another increase, decrease with an explanation attached. The explanation really comes from a footnote along with your K1. So, and then one new requirement last year is they really wanted to do the tax basis capital account reporting in 2019. They got some pushback from commenters, and so they extended it out one more year. They threw in this little instructions last year that if you did have a negative tax basis capital account, the partnership had to require it on a footnote accompanied by line 20AH. So if you did report that out last year and for whatever reason that ending footnote on the 2019 K1 doesn't match your beginning year of capital account, they want you to provide an explanation with that. In practice, I've seen that where there's potentially some inside and outside basis issues. And then they have specific in guidance if there was a difference between the inside and outside basis related to 743 basis adjustments. They do not want you to update the beginning year capital account for that. They rather want you to flush it through the current year reporting and with an explanation attached saying, hey, we're adjusting our tax basis capital account here on the K1 because last year we included the 743B basis adjustment. And if you're not sure what a 743 basis adjustment is, we'll talk about that in the next section coming up. And so then I just want to briefly highlight, so scenario 1, we reported tax basis previously before, nothing crazy there. We're just going to follow that. Scenario 2, we did not report, so we reported GAAP or 704B capital on the K1s. However, we did keep books and records for each partner on the tax basis method. You are required to report that. And then in our third scenario, let's say we did not report that on the K1s and we did not maintain records, then the service is going to give you a little leeway and you're going to have to report it on one of the 4 methods. The first one we've been talking about is the tax basis method. So you'd kind of just look back at historically what the partnership gave you and come up with that. Number 2 is the modified outside basis method. Really, this is just your tax basis, taking and subtracting out your 752 liabilities that were allocated to you, and then subtracting out any 743B unamortized amount. And next we go into the modified previously taxed capital method. This one requires a little bit more calculation, but in theory here, this is going to equal the amount of cash a partner would receive if the partnership liquidated and sold all their assets in a fully taxable transaction. A little bit more work here. I think you come up with a net liquidity value of assets. You can come up with, if you have a fair market value assessment of it, you could come up with what GAAP's reporting, but then you would need to disclose how you came up with that number and what was that value. And the very last method that the service is going to permit is the Section 704B method. And really, this is a partner's 704B capital account, and then we're going to strip out that built-in gain or built-in loss. And I think really what the service is trying to get at, they're trying to get a better picture of what's going on with the partnership and the partners to see if there's any, potentially any basis issues or, the economics are not lining up with what they should be for the allocations. And so I think we can move on to the second new reporting topic. And this gets to our code section 751A, really related to hot assets, unrealized receivables, and inventory. It's a pretty broad definition of unrealized receivables, and that includes a bunch of recapture. So a lot of times with these renewable energy clients that I've seen, there's a lot of depreciation going through the system. And then once we sell or exchange our partnership interest, we took an ordinary deduction for that. So, the IRS wants to potentially make sure you don't get an ordinary deduction at one point and then report a capital gain for the partnership interest. And so what we got to do when we file the return for the partnership is we attach Form 8308, which is pretty standard language here, report of a sale of exchange of certain partnership interests. It's a really small form. It really just says who's the transfer partner and who's the transferee and the date of the transaction. One other thing is that partnership needs to furnish a copy to both the transferor and transferee before January 31st of the calendar year following that exchange. And then the transferee partner, typically we'll just report this, the 751A gain on their 4797, and then the piece that's the capital gain, they would report it on their 8949 to accompany the return. Would have the date and sale of the exchange, gain or loss to the 751A hot asset property, and then the remainder would be flushed out, would be a capital gain. So, and then I think new in 2019, they came up with a new Schedule K1 line item, and really that's just the partnership is going to report what that ordinary gain you need to pick up is. So, making it a little bit more transparent through the system, and the IRS is getting a little bit more information on that one.
Hey, Jared, can I stop you for a second right there? I think that's a game changer for everyone, right? I think before the 751A gain was, at least for a lot of our clients, we would attach a statement to the partnership return that just said available upon request or something very nondescript. And I'm not sure how many people were appropriately calculating that 751A gain, but it's something really to pay attention to if you're receiving a K1 that has an amount reported, or if you're responsible for preparing the partnership return that includes that amount. That calculation can get very complex, and to understand all those rules it takes some time and effort. So it's not a quick calculation to get it right. So I think that's been a bit of a surprise to everyone when preparing returns, just the amount of effort to get that number in there.
Yep, well said, especially in a tiered partnership structure. If the operating plan's at the bottom, then it's a couple layers of going up the chain. Is trying to track all that down it can be quite burdensome real quick.
Yeah.
So, all right, I think we can move on to the next reporting requirement. So never can get away from Section 704C, gain or loss. But really, I think the common theme here is the IRS they want to see what's going on. And the first one is going to be item N, which is really a partner share of net unrecognized Section 704C gain or loss. And they are going to take an aggregate approach on this. And so it could be a forward Section 704C layer, built-in gain. We could have a reverse layer, 704C1C, or we can do one of those book up and downs, and it's going to be everything aggregated together. And this is on the face of the K1. And you're going to have a beginning amount there as well as the ending. And so in theory here, we just talked about item L is going to be the tax basis, right? So they could take this ending amount and they pretty much have your 704B capital account, and they can look at the economics to see if the allocations are, if they're going to agree with them. And so another reporting requirement then was line 20AA. This is Section 704C information. It's pretty vague, but in the instructions themselves, really any K1 line item that has, it could be income or deduction that has a 704C layer running through it, you're going to add that here. And what the service could do then is they'll take this amount and strip it out from your taxable income from the K1. In theory, then you should get back to your profit and loss percentages and how you should be allocating. So it's one way they're trying to look through to see how the allocations are working. Quick couple notes on this one. PTPs, publicly traded partnerships, are exempt from this reporting for both item N and line 20AA. So, and with further ado, I think we can move to poll EV and go to our knowledge check number 5. All right, so Where on Schedule K1 should each partner's share of net unrecognized Section 704C gain or loss be reported? A, on item N, B, on line 8, C, on line 9A, and then D, line 20AA.
We have about 50% answered. Give it another minute, a few seconds. Okay, we're at 90% now.
Don't know if I'm a really good instructor or that might give you a softball on that one. But let's move in forward. Our next topic of the day is going to be distributions. All right, so just got some general questions of thinking really economic considerations and capital account maintenance is the big topic here. And anytime we see distributions, I got to take a step back and is the distribution pro rata or not? How is this going to impact our tax and 704B capital accounts? I see a lot of issues, especially in a lot of operating partnerships that do take these big deductions for depreciation. Is there enough capital and appetite to take on those losses? The bigger ones I see is impacts to debt shifts under Section 752. You could potentially have impacts, if you get a distribution but you don't have any tax basis, do you have to report a gain? Other hot topics there, did the partnership really think about this distribution? Do we need to get an amendment in? You only have until the return's due, which is March 15th. So they got to be on top of it pretty regularly. So that's one thing we always look at when they come here. And then the other one is, is this going to drive our allocations for profit and loss? There could be situations where, a partner is expecting to, get some of this deduction in this year, but, their capital has just been depleted. And so, we have some regulatory allocations. We're shifting everything to the other partners. So there's a lot of things to consider once we see these distributions. And it takes a lot of work. And we have to be looking at how this is impacting the partnership as a whole and looking at those tax basis and 704B basis balance sheets. Other items, potentially you could have consequences with the character and holding period of property that's distributed out, and we'll go into a few of those rules coming up. But I think in the meantime, we're going to have one more knowledge check for you. So poll EV question number 6. Which of the following statements is not correct? A distribution of cash or property can impact the economic arrangement among the partners. B, Section 704B and tax basis balance sheet and schedule showing each partner's share of Section 704C property are critical to compute the impact of a liquidating distribution. C, a cash distribution is not always taxable to the distributing partner. And then D, a tax consultant advisor can accurately compute the impacts of a proposed liquidating distribution without the partnership agreement and redemption agreement.
Give people a few more seconds. Okay, we have about 90% complete.
All right. Thanks, everyone, for answering. And the answer on this one was D. A tax consultant advisor can accurately compute the impacts of a proposed liquidating distribution without the partnership agreement and redemption agreement. And I believe that clearly when Tom was discussing the substantial economic effects, they needed to account for that and that the liquidating distributions were in accordance with the partnership agreement. So wonderful. Positive capital accounts. All right, moving on. We're still, like I said, we're going to go and talk about current and liquidating distributions because there's a few different rules between the two. So a current distribution is just anything that, the partner doesn't terminate its interest in the partnership. the general treatment here is there's going to be no gain or loss to the partnership itself, no gain to the distributing partner unless the money distributed was greater than the partnership interest. So I think an example I gave out earlier is, say you have zero basis in your partnership interest, and they would give you cash of $50,000. You would pick up a $50,000 gain on your return. So notice how it says money distributed. This is cash. There's different rules if it's property. And then in a current distribution, no loss will be recognized. So the IRS doesn't want you taking that loss right away in a current distribution. All right, I think we can move on to liquidating distributions. Really, this is one or more distributions that will terminate a partnership's interest in a partnership. So really, that partner will have no entitlement to any of the profits, losses, or activity in any remaining capital of the partnership. Can take place over a series of events. Doesn't have to happen all at once. The recognition treatments here is there's still no gain or loss to the partnership. So same as a current distribution. There is no gain on the property unless the money distributed is greater than the basis in the partnership interest, which is the same as a current distribution as well. And then the one difference here in this liquidating distribution, no loss to the distributing partner unless money, unrealized receivables, and inventory distributed and the basis of these such assets is less than the partner's basis in the partnership interest. So one little difference on that one. And then note, as a general rule, gain or loss is recognized, generally treated as a capital gain on the sale of a partnership interest to the extent there's any 751B, those hot assets. A few other considerations that we can take for distributions, if we can go to the next slide. Yep, so current distributions are other considerations, really the holding period. So this is going to attack the property. If you received, that piece of land, the holding period is going to attack from what the partnership had. The basis in that, the partnership interest reduced by the amount of money received. However, you cannot go below zero. And then there's some basis rules under Section 732B that are outside the scope of this training. And I think we're going to get into 743B and 734B coming up next. So, all right, moving on to basis adjustments pursuant to IRC Section 743B and 734B. So first, we're going to talk about 743B. These are pretty similar in nature, but here in general, the tax basis of partnership property is not adjusted due to the sale or exchange of partnership interests. However, there is two ways we can actually adjust it to the fair market value. So number one is the partnership has a valid Section 754 election in the year of exchange. This is a one-time election. You need the partnership representative to sign, irrevocable unless you get that from the service, but it would be pretty tough to change that. So one-time election. And then the second one is a mandatory basis adjustment. And as if there's a transfer of a partnership interest with a substantial built-in loss, which is really anything greater than $250K. I believe the service kind of broadened this up, and it's a built-in loss at the partnership or in the transferred interest exceeds $250 itself. And then transactions for a 743B adjustment. There's three transactions that we could potentially adjust the basis, and it's going to be a taxable sale or exchange of a partnership interest, a death of a partner, and then a tax deferred transfer of a partnership interest. So in general, the 743B adjustment is going to equal the gain, a loss that acquiring partner would be allocated if the partnership hypothetically sold all of its assets, and then just subtracting out their basis inside the partnership. And special rules here, the basis adjustment only affects the transferee partner. And then the basis adjustment is not dependent on the selling partner's gain. So typically there will be differences of what the selling partner picks up on their own return. compared to what the step up would be for the step up or step down for the 743B adjustment. So, and the ways I think about this is, say you pay $10 for a partnership interest, and really that basis is only worth $5. You want to make sure you're getting actually the credit, and you'll get that deduction for 10. And so that you would make sure the partnership had a 754 election, and then that partner would get a step up their basis from 5 to 10. So other things, it is an asset by asset test. So there could be step downs at the same time as there are step ups, just really dependent on the transaction. And, there is different rules of how you can run those off. So. And I think we'll get a little bit more into the details of how we're going to calculate that on the next slide here. So really, this is just going to be on the net basis adjustment is going to be equal, like I said, to the outside basis for the partnership for that partner, and then subtracting out their proportionate share of the adjusted basis inside the partnership property, the inside basis. And so really the fancy terms here, and we got some treasury reg sections there that are pretty good. Consideration paid plus liabilities, that's going to equal the outside basis. And then we'll have a cash entitlement plus the share of the liabilities is going to equal the inside basis. So, and I think we got one more slide that's going to even provide the definitions for those that were on the previous one. So looking at those, consideration paid, cash, or the property that's going into the partnership, and then the share of the debt that would be allocated to the partner immediately prior to the hypothetical sale. And then on the inside basis, right there, any cash that was given, gain or loss in the hypothetical sale of the assets. That's really calculating that in a nutshell. But typically, it's similar to a 751A. They have a lot of calculations that are close, and it's a pretty close calculation together. But there's a lot of work that kind of gets involved in this, and it just takes a little bit of time. And this could happen for every time there is one of those transaction events. So you can have multiple 743B adjustments through the system, and calculate it on almost like a partner by partner basis as well. So it could get burdensome after time. All right, let's move on to section 734B adjustments. So a lot of this is going to overlap. So in general, the tax basis of a partnership property is not adjusted due to a distribution of property to a partner. So that's the one thing at the end it's really here they're talking about distribution of property to partners. So, however, there's always exceptions to the general rule, and that's what 734B is here for. Number one, the partnership has a valid 754 election in effect, or a substantial basis reduction. So similar to that built-in loss there for the 743B, it's still that magical 250,000 number. And so different transactions here that are going to be included that could cause a 734B adjustment is really a full or partial liquidation. And then second is distribution of cash or property with a tax basis in excess of that partner's a distribution in excess of that partner's tax basis. And so this is actually pretty common. And really the big benefits of having the 754 election, in this case, like my previous example is they had zero in their tax basis, but they received $50,000 of cash. They recognize that on their return. Well, if we had the 754 election, we would actually get to create a partnership inside create an asset inside the partnership and start running that off and go to the partners. And so really you would be stepping up the basis and the partnership property there. So it would match. And generally is equal to the gain or loss recognized by that partner. There is sometimes special considerations under 732D, but we're not going to discuss that here. Other things that are important to note, the basis adjustment made to the partnership's property has to be a similar character. And then generally, as I mentioned earlier on 743B adjustments, they can go either up or down. And it could be at the same time where you have some assets going up and some are down. For 734B, it's just a one directional adjustment. All right, I think I have one last slide to wrap it up, and here's just some other technical considerations in tiered partnerships. Really, when we have the Section 743 basis adjustment, and we have our partnerships up and down the chain, we need to push down that adjustment. So the lower tier partnership needs a valid 754 election, as well as the middle partnership. If not, then it potentially will not get respected. We would not be able to adjust the partnership basis in the lower tier partnership, which probably has all your assets. In most structures that we see, that's where the operating partnership sits. So, and then a little bit more of uncertainty, so we have to call in the big dogs for the treatment of certain contingent liabilities for like accrued vacation, accrued bonus, AROs, and deferred revenue. And then last but not least, the anti-churning rules do not apply, and increase the basis for Section 197 property if it's to a non-related party. So, and then I think we're about time for our next knowledge check, and that's going to be number 7. So swap out your phone or pull up your browser, and then knowledge check 7. True or false? A Section 743B adjustment occurs when the partnership has made a Section 754 election, and there is a sale of a partnership's interest in the partnership.
Okay, this was the easy one. We have the majority answered.
Great job, guys. And so the correct answer on this one is going to be true. 743B, like I said, occurs when there is a sale of a partnership interest, death, or a tax-deferred transfer of a partnership interest. And then 734B deals with distributions out to partners. So that being said, I'm going to hand this over back to Adam, and he's going to talk to you about tax equity overviews.
All right, thanks, Jared. All right, tax equity. So this slide here really depicts the general life cycle of a tax equity partnership in the renewable energy space. So the developer is going to bring in an outside investor into the project, but the developer is going to retain an economic interest in the partnership, and the developer is still going to manage the day-to-day business. The partnership will be structured to have special allocations of tax credits, taxable income and loss, and cash flow. And typically, the tax credits and taxable losses, which are driven by depreciation, will be allocated 99% to the outside tax equity investor. And as a result of the outside investor being allocated a majority of the tax credits and the depreciation, the outside investor will eventually hit their desired internal rate of return, at which point the developer is going to execute the purchase option, and they will purchase the investor's equity interest in the project. So overall, that's kind of the general life cycle that usually happens. Usually, I don't know, that could be anywhere from 5 to 10 years is when the investor will ultimately be bought out. I think you can go to the next slide. Okay, so why monetize? Why does the renewable energy use these tax equity structures? And the main reason is because the developer does not have the ability to use the tax credits. So usually they're not generating taxable income because they're just constructing and developing these renewable energy projects. So that's really why they're entering into this transaction and bringing in a third party. And it's also another way for the developer to use less of their own capital on a certain project. They can now go take that capital and use that to, start the next project that's on their list. And typically, the outside investors, the tax equity investors that you're going to see come into these structures are large banks and insurance companies. and large corporate entities that really have the appetite to use the tax credits and the tax losses. Go to the next slide. Okay, so there's two types of credits in these renewable energy structures. There is the production tax credit and the investment tax credit. So production tax credits are going to be based on kilowatt hours of electricity that is generated for a 10-year period, and that's going to start on the placed in service date. And the electricity that is generated needs to be sold to an unrelated person, and the PTC must be claimed by the owner of the assets that are actually generating the electricity. We look at the investment tax credit, the ITC, there's some differences there in that the ITC is going to be based on the amount spent to kind of construct a qualified energy property. And that ITC credit is going to be recognized at the placed in service date. So in year one, where PTC is kind of a 10-year credit. For the ITC, there's no third-party sales requirements, and the ITC can actually be claimed by the owner of the assets or by an entity that is actually leasing the assets from the owner. One thing with the ITC to consider, there is a requirement to reduce the basis in your assets by 50% of the amount of the ITC that you receive. So you are going to get a haircut to tax depreciation in the ITC structure. And I'm sure this will be covered in the next more expansive renewable energy training, but there's a lot of different rules out there in regards to when construction needs to begin, and what the phase down rate of the credit is, depending if it's PTC or ITC, onshore wind, offshore wind. So we're not going to get into all those rules here, but there is a lot of guidance out there in regards to the availability and amount of credit that's available. You can go to the next slide. Okay, so flip structures. So as previously discussed, the renewable energy developers typically do not have any taxable income and no use for the tax credits. And that's why they're bringing in a tax equity investor. And there are typically three structures that we'll see in this space. The first one's going to be the partnership flip structure. There's the sale leaseback structure and the inverted lease structure. So the structure chosen usually depends on what the tax equity investor is looking for. Each structure has different strengths and opportunities for the tax equity investor. So it just kind of all depends on what they're looking for. But the most common structure that we do see is the tax equity partnership flip structure. So if you go to the next slide, little org chart on a typical tax equity partnership flip structure. Pretty basic in regards to, you just have an investor coming in and becoming a partner in the partnership, and they're going to be allocated a large percentage of the credits and losses of the partnership in kind of the early part, the first 5 years of the partnership's life. I think if we fast forward to the next slide, there's a little more detail on some of the economics of a typical partnership flip structure. So from inception through the flip point, the investor is typically going to be allocated 99% of the credits and 99% of the losses. And most of these losses are generated from depreciation on a 5-year maker's asset. And during this pre-flip point period, the investor is also going to receive some share of operating cash flow distributions. So I keep throwing out this word flip point and tax equity flip. So there's usually two methods for determining the flip point. There are going to be deals that are structured as time-based flips, and this is really going to say the flip point is going to occur at a certain date in the future. And then there's going to be deals that are structured as IRR-driven flip points, which the flip is going to occur once the investor receives a certain internal rate of return, for example, 8%. So once the flip point occurs, whether it's time-based or IRR-driven, after the flip point, the investor is typically allocated 5% of tax items. And at this point in time, like I said, it's usually a 5-year maker's asset. So usually depreciation has run off. So after the flip, you're usually going to be in a taxable income position because you could just kind of have your gross receipts and expenses from operations. And then after the flip point, the developer is typically going to execute the purchase option to buy out the tax equity investor. One item to note is that, there's always extensive legal agreements associated with these structures, and those agreements will always restrict the investor from selling their interest during the 5-year period after the project is placed in service. And this is really to prevent ITC recapture. So there are rules out there that say you have to, maintain your investment and ownership in that partnership for 5 years. And if you were to sell your interest, the IRS is basically going to make you pay back that credit you took in year one. We can go to the next slide. Okay, so I guess I'll give it just kind of a brief background on some of the structuring considerations associated with partnership flip structures. So there's a couple different ways to structure these. One would be a MIPA transaction, which is a membership interest purchase agreement, or a revenue ruling 99.5 situation 1 transaction. So this is really a purchase over the top. So the investor will purchase an interest from the developer in a taxable transaction, and the developer is going to pick up gain. There's going to be a step up in the assets for the percentage that was purchased by the investor. So there's going to be increased ITC basis on the percentage that was sold, which is, what these partnerships and the tax equity investor, they're all looking for, ways to get more ITC basis and, tax basis into the system. So second transaction is going to be an ECCA transaction, an equity capital contribution agreement, also known as your revenue ruling 99.5 situation 2 transaction. And this is basically where the investor is going to contribute cash to the partnership. And in some situations, that cash may be distributed to the developer. Sometimes that's potentially going to be tax deferred, but you kind of need to go through the disguised sale rules associated with that distribution. In this structure, there's typically going to be a developer fee that is paid by the partnership to the developer. Again, another mechanism to trigger more ITC eligible basis in the assets. Unlike the MIPA transaction where you had a taxable sale, the ECCA, you don't. So you're looking for another way to get that step up in basis. And kind of the third structuring consideration that we'll see is using the ECCA transaction, but having both partners, both the developer and the investor, contribute cash into the partnership, and the partnership then goes and purchases the project from a different regarded entity of the developer, basically triggering a full basis step up to fair market value, which again, yes, it's resulting in gain pickup by the developer, but it's resulting in incremental ITC basis in the partnership. So in these structures, the investor is typically going to enter into a deficit restoration obligation. I know Tom talked about this previously, but that's extremely important in these structures, because what needs to happen is, in order for the investor member to be allocated 99% of the credits, they also need to be allocated 99% of the taxable losses during year one. So sometimes they might not have contributed enough capital to have a positive 704B capital account, and they need that DRO to maintain that 99% allocation. Also in these structures, we're going to see a lot of 704D suspended losses and 731A gains. And then, as I discussed on the previous slides, after the flip, the developer is going to exercise the purchase option, buy out the investor member. That is going to terminate the partnership under a revenue ruling 99-6 transaction. I think we can go to the next slide. And I know we're running short on time, so I'm not going to go into much detail on this slide. I'll just say that, the IRS has released RevProc 2007-65, which established requirements that must be met for the IRS to respect the partnership allocations in regards to wind energy PTC projects. So this slide kind of lists some of those requirements that must be met. Go to the next slide. Okay, so just again, I'll probably go through these quick because I know we're running short on time, but some issues that are going to arise in these structures is, property is going to be sold into the partnership to trigger a full step up of basis and increase ITC. There always needs to be an appraisal and cost segregation study that's going to provide that support for the purchase price and really that support for that increased ITC basis. Determining placed in service date is extremely critical in these structures because ITC is claimed on placed in service date. So obviously the tax equity partnership will need to be formed prior to the placed in service date. So placed in service date, it's really a facts and circumstances test, but the IRS has issued, 5 prongs to consider when determining the placed in service date. I think we can move on to the next slide. Okay, so some other kind of high-level items to consider in a tax equity flip partnership is there's always going to be a deal model that is going to be done to show kind of the intended allocations and economics of the partnership over the life of the project. So when you're going through tax compliance on one of these tax equity flip partnerships, it's a great item to, look at and consider as the tax equity model kind of shows, what's projected to happen. Other items, you're going to see disguised sales, 704C allocations, stop loss allocations once an investor reaches their DRO. If the tax equity flip partnership has project level debt, you're going to run into minimum gain allocations. Typically, we'll see a lot of back leverage debt structures over project level debt, but you will encounter that at some point. And then Tom mentioned the cost of goods sold point in regards to inventory, electricity being treated as inventory. And really the main thing I want to get across is just due to all the 704B complexities in these structures, such as DROs, stop loss allocations, Section 704C, and minimum gain, maintaining tax and 704B basis balance sheets and tax and 704B capital accounts is extremely crucial. And then I guess the last item, HLVV accounting, just another complexity associated with these structures. Since these are varying interest partnerships, the HLBV method, which stands for hypothetical liquidation at book value, must be used to determine how the gap, income or loss, gets allocated between partners for financial statement purposes. So I apologize. I know I went through that pretty quick, but with that, I'll turn it over to Kim.
Yeah, so we have gone through a lot of topics about partnerships in the last hour and 45 minutes. So we do have case studies prepared, but they're really more examples about all of the things that we've talked about. So instead of spending time doing that, I'd like to stop for a moment and see if any of you have questions that you want us to address. Otherwise, I will probably go through one case study that is really focused on what Adam talked about, and that's kind of a sale over the top that we see quite often in this space. But I want to make sure we answer questions first. So if you have questions, jump in, use the Q&A chat, or maybe if you're all ready just to walk through one example together, just send me some thumbs up using some emojis. Is there anyone still there? Okay, we're gonna, if you could go to the case study C, Christina. I think it starts on page 93. There you go. So this is really what Adam was talking about when we see a MIPA transaction. It's fairly typical where we really have a partnership that may have already been formed, or we have a single member LLC and we admit another partner in here. So here's kind of our facts we'll walk through. I don't think the remake of Top Gun has come out yet, or the sequel. I'm not sure what it is, but we're prepared for it here. So we have Maverick and Goose that have Top Gun, and Charlie, you'll remember, is the love interest, I believe, in the original movie. And so Charlie is going to pay $10,000 to Top Gun in order to be admitted into the Danger Zone partnership. And so Charlie's going to purchase that 50% interest over the top. And so this example falls squarely into the 99.5 rules, and we'll talk through here what happens. But you'll see what our partnership agreement provides here, but it basically ends up with a 50-50 partnership, which is different than what you'd see in a typical tax equity partnership, but I think it gets the point across here on how this works. So if you can go to the next slide, Christina. So in this case, first we have a sale, and this is under Revenue Ruling 99.5 Situation 1. So first we have a sale of 50% of the assets and liabilities from Top Gun to Charlie. And then we have Charlie and Top Gun deemed to contribute those assets into Danger Zone, into this newly formed partnership. And so Top Gun has a gain on the sale of the deemed sale of those assets. And then Charlie has a basis that's equal to the fair value that she paid for those assets and were subsequently contributed. Go to the next slide. Okay, so then we set up capital accounts, and you'll see here that by setting up all the capital accounts, there's not a great way to show this easily in a PowerPoint slide, but when you set up your Excel work paper, right here we have Danger Zone, so that's the total partnership, and you'll see that there's the cash that was contributed. There we have the property that was contributed, your 704B, so that's the value of it. And you'll see that because it's a 50-50 partnership, from a 704B perspective, Top Gun and Charlie both have $16,000. But from a tax perspective, right, we have carryover basis from Top Gun, and we have stepped up basis for Charlie. And so this kind of situation really gets you to to think about all of the concepts that we've talked about here, in that we have a 704C layer in this contributed property by Top Gun. There's a built-in gain. And we've had a taxable transaction, and we have these 704B accounts that we have to track. We also have the fun of having some liabilities, which always add complexities to these partnership transactions. So, does anyone have questions about this situation, or is this a situation that you typically have worked through, and maybe want to share some stories from how you've had to deal with these issues? Okay, well, I'd say, kind of to wrap up, right, I think that hopefully if you've kind of caught the high points here from this training, is a few things. First of all, the maintenance of capital accounts is really required. And I think that I've seen plenty of clients in my career that have not put the emphasis on maintaining capital accounts. And not only because of the new reporting requirements, but just because of all the complexities in partnership deals, the maintenance of those capital accounts is really, really important to do all of the time. And those have to be maintained each year to make sure that your allocations are right, to make sure your liquidation works out right, and really just to make sure you don't have an error, quite honestly, throughout the life of the partnership. And so if we've hammered home anything, right, it's the importance of maintaining capital accounts and following all those allocation rules, and then just keeping your head up for all these different transactions that can happen as your partnership operates upon formation or upon liquidation that can cause some fairly significant tax implications. So one more call for questions, or Adam or Jared or Tom, do you have other things that you want to mention as we wrap up?
I think Kendall raised her hand and they have a question.
Couldn't resist. Yeah, I had to.
Hey, Kendall, how are you? I haven't heard your voice in a while.
Hey, Kim, what's going on?
You know,
I'm here.
Good to see you.
2.5 more months. Going to retire at the end of June, but I'm still plugged in.
I heard that. Congratulations.
About the danger zone when I retire. I'll be right back in it. But man, loving this example. Hey, what's the minimum gain in the danger zone, and how is it dealt with in the allocations under the kind of HLBV stuff?
Yeah, so you hit a lot of hot topics there. So you'll have partnership minimum gain if we have all of the people, if the partnership itself essentially has debt that supported the allocations, right? So we have negative tax capital for everybody, but we have debt, that's going to be your minimum gain. As far as how the allocations will work, right? So if you think about, first you have to get to partnership minimum gain, and then you determine. So let me back up. So if you're in partnership minimum gain, then you've kind of gone through everyone's capital account, if you will. Oftentimes you're not in that spot right at first, because one partner will have sufficient capital account, so it's a reallocation of those losses to get everyone into that min gain land, if you will. But after you've gone through everyone's capital account and you're in minimum gain, then it depends on how that would be, what your liquidation provisions are in your partnership agreement to determine what your allocations would be. So it's hard to say so in a 50-50, right, you're going to stay 50-50, assuming everyone goes into. So in a 50-50 partnership, you're all going to go into minimum gain together, and you're going to have allocations kind of staying 50-50 throughout the life. That is not going to be the case in a tax equity partnership, where one partner is going to have capital that's greater than the other, and you're going to have disproportionate amounts of capital.
And then I will add for HLBV, minimum gain is a regulatory allocation. So I would expect in a HLBV waterfall, you have a gain on liquidation. Kind of the first step of allocating that gain is going to be the regulatory allocation. So you're going to have that min gain chart back charging back all the losses you've been allocated under min gain.
Yeah, that's the kind of a tricky not tricky, but so min gain is basically in the case of when it's relevant for HLBV, it's the gain upon liquidation, right? Where the asset value would exceed the liabilities.
Yeah, so the minimum gain
basis would exceed the liabilities.
Yeah, minimum gain is really the amount of gain you would recognize if you sold the assets for their book value.
Tax book value or book value?
Book value.
Book value. Okay. Well, that's about as much as my brain can take. Okay, I think I get. Be careful in the HLBV though. That's right. That's something to watch
We
out
could
for.
have a separate 2-hour session on HLBV because I think that there's tons of issues and traps.
Yeah.
And tax people trying to explain capital accounts to financial reporting teams that are, it's a problematic situation. We'll just put it that way.
Well, that's one of the few times that tax really drives the financial accounting. And we found just some funny answers, with our HLBV accounting, particularly in year one on these tax equity partnerships, and so we're going to have to be awful prepared to not only talk to our accountants about it, but get the world because of the volatility in earnings that it creates.
Yes.
So you're going to have to write up this really simple, easy to explain. Yeah. Anyhow, we'll be back.
Let's take that offline, but let's absolutely talk about that because I think we can help you think through that a little bit.
Yeah. Thanks, Kim. Appreciate it.
Okay. Well, we are running to the top of the hour. I want to be respectful of people's times. We have one last polling question number 8 that you can answer at your leisure here. And then if you could also sign out of Poll Everywhere, that'll get you the additional credit. So again, we are happy to answer any questions offline. You have all of our contact information. These slides will be available. And so you will have that soon. So.
And I'm going to give it a few. Sorry, Kim, this is Christina. I'm going to give it a few more seconds for everybody to answer this last polling question, and then I'm going to go ahead and activate the checkout question. And please know you can go ahead and log off of this WebEx. I will keep the checkout question out for 5 minutes, so you'll have time to log out as you're logging off.
Great. Well, thank you again all for joining. We appreciate your staying with us during this session, and we look forward to working with you and hearing from you soon. Have a good day.
Absolutely. We'll be in touch.
Okay,
Lots to talk.
Yeah, great.
Yep, thanks, everybody.
Thanks, everyone.
Yep, see ya.
Thanks, everyone.
Thanks, guys. Have a great day.